request you to just stay with us. For the time being, let's invite our first corporate on the show this morning. It was a good performance coming from SKF India in the Q1. Price realization aided the revenue, while better mix and low cost have aided the profitability. Mr. Manish Bhatnagar, the MD of the company, joins us on the show. Hi, Mr. Bhatnagar. Good morning. Thanks so much for joining in. Well, the first quarter was fairly good, actually. For the year, what kind of revenue growth are you penciling in? And how much of contribution do you see coming in from railways? There's a lot of buzz on that segment. So how do you see that contribution scaling up as well as exports?
Well, we do expect revenues to be double-digit growth for the year, in line with what we've done in the previous few quarters. Specifically on railways and exports, and I do point this out at every call and every interview, that they are not the two largest segments for us. So exports is about 7%, railways is about 7%. So I do understand the buzz around those two segments, but they're not really needle movers for us.
Sure. I guess, there's a lot of focus on the railways from the government's end as well. Things are picking up fast. So I guess that's where all the interest stems from. But Mr. Bhatnagar, the other thing that the market would definitely like is the fact that your margin profile has improved substantially over the last 5 years, right? I mean, 5 years ago, I think you were functioning at about 12-13% margins. And by the end of Q1, you're almost at 18%. Do you have any more levers to expand margins further? If yes, what are they? And where do you see your margins by the end of FY24?
Yeah, so, we've been working on our strategic imperatives for the last few years, and we unveiled a brand new strategy last year, really doubling down on what we think are the high growth areas for the future. So, for example, clean tech is a big growth initiative for us, and clean tech is electrification, clean tech is renewables, and by the way, railways does form part of clean tech. So that's one doubling down of growth bets. The other one is around the future growth segments linked to our economy. So infrastructure, cement, steel, high-speed machinery. That's the second lever. Specifically on profitability, I think we're taking a very, very hard look at our pricing. You mentioned that in your opening comments, but also on the way we manage our portfolios. We really want to be focused on profitable accounts, profitable products, and profitable ways of going to market. So there is always an upside on margins, and we hope to constantly deliver on those.
No, when you say an upside on margins, what are you looking at? I mean, is it enough? Are these levers enough for you to get to, say, 20% plus? Will you be in the 17-18% range for this year? Just to give our viewers a sense of which way things are headed.
Sure. I think we are certainly aiming for very high double digits, so upwards from where we are right now.
Okay, well, that's knocking at the 20% level then, somewhere there. Manish, hi, good morning. Prashant here. So you've told us about the new areas of focus, etc. But the older segments, the aftermarket business, both in automotives and industrials, I think combined is about 40% of the business right now. How is that doing? Could you give us a sense, and what's the potential there?
The aftermarket on industrial is really running on all, firing on all cylinders. No issues there. The aftermarket on automotive becomes a little more challenging because the aftermarket in automotive is more retail, is more mechanics, it's more price-led. It's not so much performance-led. So there, the levers for growth or profitability are frankly localization and pricing. And what we are focusing on now is reach. The more we can reach, the better we have sales. But on industrial, the levers are completely different. There it's performance, because these are companies, OEMs, buying bearings to replace the current bearings in their machines when they break down. So there the focus is, of course, on performance and innovation, and not so much on pricing or reach. So the different strategies for different segments.
Manish, got that. So industrials is firing, auto may be a bit more challenging. You spoke about buzz, right, and sector buzz. The other sector buzz is that industrial capex is picking up in a large way. Not chunky, large projects, but it's more widespread, etc. Are you seeing that? I mean, you will see that before anyone else. And can you give us how long is that this runway? If this has started, go on.
Yeah, we see this more than any other industry because bearings are used in almost everywhere. The last capex
Yes.
cycle, as you know, ended in 2008. It's been 15 years waiting for those green shoots. But the last 6 to 12 months, those green shoots began as announcements, and now we are seeing actual capex picking up. And as you know, a big trigger for capex is capacity utilizations. Capacity utilizations in many of the sectors, steel, cement, automotive, some segments, energy, are nearing 75% plus, and those are near their all-time highs. So clearly we are seeing capex pick up, and very, very hopeful of the future on that.
Well, that's very good news then, CAPEX picking up. And we take that point on board as well about railways. Since there's a lot of buzz out there, so we normally tend to ask about that, but we get that point. 7 to 8% is what it's contributed, and it will contribute to that. My other question to you is, are you all planning to localize the parents' portfolio in a big way? And I asked you this after the cost of production, it's spiraled up in Europe, and also de-risking away from the supply chain. That's away from Russia. So is that a focus area?
Yes, thank you. That's a great question. Absolutely. Localization is a huge focus area for us. And I do want to point out it's localization not just about making bearings locally, the comment you made about localizing parents' portfolio, but also about localizing supply chains. Unless we localize steel sourcing in India, there's no point. We really can't do much with manufacturing bearings in India. So we are focused on everything, localizing supply chains, so steel, rings, and also localizing manufacturing. Today on automotive, we are about 95% local. On industrial, we are about 40% local. And of course, the aim for industrial is where there is room for growth to get to about 60, 70%. So most of our investments are now focused on industrial localization.
Okay, that's great to hear. Just one final question. I remember imports used to be a bit of an issue, the threat from imports, especially low-value imports in the aftermarket. Is that still a concern for you, and how are you addressing that? And also, if you could talk about whether there is a lot of competition coming in from spaces like China?
3 years ago, absolutely, yes. Pre-COVID, there was a lot of competition from China. We were concerned about imports from China, Eastern Europe. But I think in general, supply chain disruptions have caused those imports to slow down. I would not say they've reduced or gone away. They've slowed down a little bit. We still face some imports in the aftermarket, some segments, but by and large, it's not something that keeps me up at night anymore.
All right. All the best. Thanks a lot for joining in, Mr. Bhatnagar. Appreciate your thoughts here. That's SKF India. Let's take it straight to